And welcome. It's Mary Ellen McGonagle here with your Friday afternoon MEM Ed Show, the show where we bring you where the action is in the broader markets. Another bumpy ride last week. We are going to get into just about everything. Take a look at where the markets closed, what's shaping up beneath the surface, and what we need to be on the lookout for as we go into next week's important tariff announcements. But before we do that, let's take a look at some of the data that drove the markets lower last week. And among them, we did see consumer confidence. It dropped to a 4-year low. You'd have to go back to 2020 to see confidence at that low level. We also did get news about chip potential restrictions that pushed Nvidia down and other semiconductor stocks. So a lot of it is going to be policy related as far as the market's deterioration. And we did see volatility climbing quite a bit. We'll take a look at that chart as well. Trump did announce a 25% tariff on all foreign automakers. That, of course, was not good news. We did see the markets bounce into Monday on hopes of reduced tariff fears, but not the case. We still have quite a bit of uncertainty surrounding that. And then, of course, as mentioned, next Tuesday, we will get further information relating to those tariffs. Also, we did see Q4 GDP was revised slightly upward. That was generally positive, and unemployment claims declined slightly, but it was not enough to override that fear that I've been mentioning. Now, next week, in addition to those tariffs, we will get the employment data for March, and these employment data has been known to move the markets. So let's go ahead and jump in and take a look. Where did we close for the week? And here we are, a daily price chart of the S&P 500. And you may notice a bit of a difference over, certainly at least last week, is the fact that in addition to keeping this highlighted move here back in the middle period of August when the markets turned constructive, I've added newer indicators that highlight negative characteristics. And in particular, on the S&P 500, we're taking a look at the stochastics. Now, these are a faster moving momentum indicator. Some would argue that it can be whippy, but what I'm keying in on is the fact that we are close in the S&P 500 to getting a negative stochastic, which is a move below 50. So if we go back quite simply to this period at the end of December, quite a tough period for the broader markets, and then again going into March, when those stochastics turn negative, we need to take a look only at this decline that took place then. So not a particularly good look at all. The RSI is heading in negative territory. As for support, we're going to look at recent lows for that first potential area of support at around this 5,500 level. And then as for upside resistance, it will be these moving averages as we potentially may continue to firm up. Now, last week we did have that so-called firming up where the markets were in the beginning stages of potentially reversing this downtrend. We had a very nice move back above that 200-day simple moving average. The RSI briefly dipped into positive territory. However, as you can see, we did end the week on a weak note. So not what we want to see. Let's go ahead from here and take a look at the S&P 500 using the MACD in addition to those stochastics. I talked about how whippy the stochastics are. Down here, this is the moving average convergence divergence. And while we did get that bullish crossover, that's that black line up through the red, we are still in negative territory below that net neutral 50. From here, we want to take a look at the Nasdaq composite because last week it was the hardest hit. A lot of M7 stocks and elsewhere came under selling pressure. So when we are looking at the Nasdaq, you'll see that we never got that RSI into positive territory. We are, of course, sloping downward. Sharp drop today, almost 3%. And we can see that the stochastics are also in this negative territory. on the Nasdaq, and we are now below this 2200-day simple moving average, as well as that 21 and 10-day. So very negative price action in the Nasdaq as well. So from here, let's go ahead and take a look at the underlying sectors in the S&P 500. What we're going to do is go to this initial interface page where it has that sector summary and really highlighting what took shape today as far as growth areas being the hardest hit and some of these more defensive areas sitting here at the forefront. But let's go ahead and take a look at the overall price action for the week. And what I'm going to ask for here is what's called a sector candle glance view. Go ahead and add that RSI and sort it in descending order. We're looking at a 2-month daily price chart view of those 11 sectors. And let's take a look. Now, energy still up here at the forefront. It did outperform the markets yet again this past week, but also taking a look at these front runners that are relatively outperforming, you can see that it is consumer staples, utilities, and REIT stocks, all known to be defensive. They do offer that nice higher yield and a bit safer in this very volatile market. Now, taking a look at these weaker areas, technology continues to get hit down 3.5%, much of that decline taking shape today. And we can see that, again, similar to the Nasdaq, we did not get that bullish RSI. And we now have this index below each of its moving averages and super close to undercutting this very, very recent low. So not looking healthy there in the tech space, but let's go ahead and take a look at consumer staples XLP. And you can see, unlike the broader markets that had a fairly steep sell-off, you can see that staples have been back and filling and then into Wednesday and Thursday, nice rally days. Today, a little bit of a pullback, but we are generally seeing constructive price action in the consumer staples. Now, talking about the broader markets, we are down Q1 minus 5% in the S&P 500, and that is the worst Q1 since 2020. Unfortunately, we all know what happened in 2020, so keeping that in the back of our minds. One other factor, I'm going to take us back to the S&P 500. You can see we had this wedge-like potential rally and then a pullback. First up, we can take a look at the weekly chart here because this is going to provide a longer-term outlook for the markets. You can see the RSI is below 50 and continuing to trend lower. If we go back historically, it's not super common for that RSI to dip into negative territory, and you can see that oftentimes that does provide insight as it relates to a longer term potential decline. We are also taking us back to the daily, coming out of an oversold position with the S&P. We did get that RSI down below 30. That's one of several oversold indicators, and this rally did not materialize as strong as investors and traders were hoping. So at the end of the day, we are entering next week from a relatively weak position. Now, moving through, taking a look at the underlying ETFs beneath the surface of the sectors, I did want to share with you that the Volatility index, I did mention it did spike today, up about 16%. We're sitting here at about 22 on that VIX volatility index, which is a negative. It's indicating that fear is really quite strong. And I hate to keep jumping, but I am going to take us back because it is reminding me of another view that we can take a look at relative to the put-call ratio. And what I am sharing with you here is a view of the percent of stocks above or below that key 50-day simple moving average. In this case, it is the percent that is above. And you can see we've dropped down to 35. So only 35% of stocks in the S&P 500 are currently above that key 50-day simple moving average. And interestingly enough, that put call ratio is below 1. We are sitting at about 0.7. So while the volatility index is indicating a spike in fear, we're not seeing it confirmed by this put call ratio. So at the end, perhaps by Monday, we may see confirmation of that. Now, moving through and taking a look at some of these other ETFs that are really quite helpful as far as getting your arms around what is shaping up beneath the surface. Let's take a look at the yield on that 10-year treasury. And you can see today it dropped about 2.5%. Some of this a flight to safety. You can see we're sitting down here at about 4.25. So a reduction in this yield is going to be good for bond funds. I'm going to share with you a fund that has a high yield and is in some of these higher dividend bond type categories. Also, we do have that relative strength indicator, and these ETFs are sorted by relative strength. So what I wanted to highlight for you is the fact that most of these ETFs are well below their key 50-day simple moving average. That would be minus the volatility index. And if we look, we talked about technology getting hit hard. Here is a daily price chart of the iShares Semiconductor ETF. And this had a very tough week, down over 5%, undercutting these recent lows, not what you want to see, but semiconductors, certainly in addition to being economically sensitive and cyclical, they are also coming under fire due to Trump policies that are looking to restrict sales to China and elsewhere. Also, taking a look at these ETFs, we can also look at small cap stocks. Now, the small cap area performed relatively well, certainly to the Nasdaq. And however, we are still very much in a confirmed downtrend. This is the Russell 2000 IWM index. And you can see we have this downward trending 50-day. Once we cross this 200-day below it, moving average that is known as a death cross, and on the lookout for potential further weakness in small cap stocks. Also looking at some of these other areas that have been getting hit by the markets given the uncertainty, and biotech makes a lot of sense. IBB is the Nasdaq Biotech ETF. And during these periods of heightened uncertainty, you're not going to see investors pouring a lot of money into these high-risk biotechs that do not have earnings. And it is certainly making sense that it is in that area that is underperforming. Let's take a look at XRT. This is that retail ETF for the S&P 500, down only about 1%. You can see we did have a gap up on Monday. Now, a lot of this was Tesla and then Amazon both names started the week out relatively strong. They lost their luster, as did other retailers. Lots of deterioration, as you can imagine. We peaked in price back here in the beginning of December with these retailers. Let's take a look at a company that reported last week and well-known, came out with numbers where the company guided growth estimates lower going forward. And this is Lululemon. It dropped about 14% on the day, gapping down super heavy volume. And we had been eventually or potentially emerging out of an oversold position into a bullish place. Not so. The markets did punish this name as well as other retailers. So from here, I did mention that there are some areas that are outperforming, and we're going to take a look at them and why. But first up, let's take a look at DJP. Now, this is the Bloomberg Commodity Index, and I will surface back here and see if, in fact, I did not highlight that. So we are going to take a look at gold stocks. They have really done well, certainly relative to the markets, up about 2% last week. Again, flight to safety there. And DJP is one of many ways that you can play a move into gold stocks. Let's take a look at GLD, which is the S&P gold shares. And here we are with 2 days gapping up into a base breakout on very heavy volume. So we are seeing that move into this safer area, gold. Also taking a look at the Dow. The Dow Jones was down industrial average 1%. That's relative to the S&P, down 1.6. Nasdaq down 2.6. So we're going to take a quick look at the Dow components. This is a type of exercise you can do very easily on Stockcharts.com, where you have the Dow components available. And from there, you can quite simply take a look at this performance over the last week. What areas were able to help the Dow relatively outperform the other broader indices? And first up here, we can see Coca-Cola. We are going to get into some of these names as we move through the markets today, but not a whole lot of green, certainly almost half, but we do, of course, have a lot of deterioration down here that cannot be ignored, but oftentimes it can be of interest to take a look at those names that are outperforming an otherwise deteriorating market. You're on the lookout for names that are not viewed as defensive in nature and that could sustain their potential uptrends. We're going to take a look at Verizon. Visa would be another name. Let's take a look. This is another exercise where you can very simply go ahead and access the chart. This is Visa, the payment processing company. You can see the move back above that 50-day, that MACD getting into positive territory. So from here, what I did want to share with you are areas that also are outperforming the broader market. So first up, we are going to take a look at XLU. And this, of course, is the utility ETF, not highly uncommon for utility stocks to generally outperform. And not the most terrific looking chart, but from here, I will share with you some of the highlighted names underneath within this sector that are setting up quite nicely. This is Chesapeake Utilities, CPK, and you can see this advance above these key shorter term moving averages. And then leading up to that advance was pullback days on Wednesday and Thursday, but the stock closed in the upper reaches of its trading range for the day, and that is generally bullish behavior. And today's move moved the stock back above, again, those moving averages. We have a positive RSI, positive MACD poised for a potential crossover. Let's go ahead and take a look at a full quote. And from here, we can get a sense of that yield, in this case, 2%. There certainly are candidates that have higher yields. This is another utility name, Duke Energy, DUK, very similar characteristics, trading back above these moving averages, having 2 days of closing in the upper reaches of its trading range, bullish RSI and MACD. And then last up, we'll take a look at a Canadian ETF. This is FTS, that's been in a very nice uptrend. From here, I did mention to you staples, that sector that is coming back into positive territory here with the close above that 21. That MACD black line up through the red, and RSI, not terribly exciting, but certainly an area where you can search for potential outperformers. This is Altria Group, MO, formerly Philip Morris, and you can see that we had a nice orderly pullback to that 21-day simple moving average. Your RSI remained positive, and we now are poised for a potential MACD crossover. From here, we'll take a look at TSN. This is Tyson Foods, and you can see this gap up that took place yesterday, a little bit of a continuation rally, although we ended the day flat, but we are very close to a $63 base breakout, black line up through the red, signaling a new uptrend, and then a positive RSI. The stock does yield 3.21. Now, other areas that are holding in fact, last week we did talk about the auto tariffs, and what I wanted to share with you are related companies that to the auto industry that are actually helped by those tariffs. Now let's take a look. These are stocks that had been relatively outperforming, but they really sped up last week. This is ORLY, which is O'Reilly Automotive. And the concept here is with the expected increase in auto pricing. Let's take a look at GM, for instance, gapping down, continuing lower, that there will be individuals, a lot of people potentially retaining their existing vehicles and looking to keep them in good shape. This is an automotive parts and provider. So we can see we had this nice base breakout on Thursday after the announcement of those tariffs. And then again, we had that black line up through the red, signaling a new uptrend. And then another name that is in that same area, and that is AutoZone, AZO. We can see that base breakout on Thursday and a potential continuation rally. From here, I always like to take a quick peek at that intraday. This is a 15-minute daily price chart, and you can see that throughout today, we did pull back. We now have a negative RSI and a negative MACD. This would be for those shorter term traders. You can see it does not get quite a whole lot of volume, but look for a move back above those moving averages and a bullish RSI for short-term potential movement in the stock. AAP is another name that's in that industry group, Advanced Auto Parts. Not as interesting simply because we are still in the throes of a longer term trend, which is down, this 250 as well as the 50-day simple moving average trending downward. We do not have bullish characteristics in that momentum. So that particular name is not going to be quite as exciting. And then two more names that are in a different area. And first up is Carvana, CVNA. And of course, they do auto sales of used vehicles. And we can see that we did have a bit of a move higher, found resistance at that 50-day simple moving average with relatively flat RSI, so not quite as interesting. Last up is CarMax, another name that is attempting to reverse. Now, at the end of the day, while there may be increased purchases of used vehicles due to new vehicles being too expensive, this chart is telling us that net consumers do not have that confidence to purchase a car relative to whether it's new or not. Now, XLC, we can take a look at the communication services. We know that the heavyweight names, Alphabet among them, did not fare well. Meta, both underperforming. However, there is an area in this communication services area that is faring well. And quite simply, it has to do with the fact that as citizens, we are dependent on mobile devices, and a lot of investors are treating this area as something of a defensive or staples area. People are most likely not going to be giving up their mobile devices. And if we take a look here at AT&T, you can see that we on Thursday had a nice base breakout, nice black line up through the red with that MACD crossover and a positive RSI. AT&T did come out with strong numbers, and they are expecting to experience growth through 2027. So what we can do from here is take a look at the weekly chart of AT&T, and you'll see we had a pretty big move for a mega cap name. So I would not chase the stock, but certainly we are still looking somewhat compelling on that longer term chart. From here, let's take a look at T-Mobile, TMUS, and this stock has not quite yet, but it's poised for a 275 base breakout. We can see that black line just poised to enter into positive territory. We do have positive RSI. The company has announced they have the highest number of customers in the history of the company. Also in Q4, 60% of those new customers signed up for premium plans, which are more expensive, but also provide TMUS with higher profit margins. So that name is setting up quite nicely there. And then another area that we can take a look at, given the tariffs and other accounts that are taking shape. Let's take a look at ACI, some of these defensive supermarket names. This is Albertsons. You can see we pulled back to that 50-day simple moving average, poised for a potential downtrend reversal into positive RSI and a positive MACD. So we have experienced that downtrend reversal. Likewise with Kroger, KR, looking to form the right side of a base on its way to a potential $68 base breakout area. And then this may be a little bit of a reach, but it was a name that was highlighted by analysts as another company. When you look at tariffs and areas where retail goods are being imported, if you look at eBay, this particular company, by and large, is offering products that have already been imported and are here. And EBAY is trading above this 50-day simple moving average. Not overly exciting, but certainly something of note. I talked about REIT stocks, and they're not looking overly exciting. You can see that the momentum here has trended sideways over the last 2 weeks, back and fill. We do have that MACD down in negative territory. The only good news here is relatively it is outperforming. I'll share with you one area in the REIT space that is faring well, and it is senior housing among them. This is Ventus VTR, and you can see in line with the group that it is back and fill over the last 2 weeks, but a little pickup here in that momentum with that RSI trending upward, looking interesting, a nice 2.8% yielder. Another senior housing name that we can take a look at in that REIT space is WELL, Welltower, and you can see that we are back above these moving averages. If we can get that nice black line up through the red, the stock is potentially forming the right side of a base, about a 1.8% yielder, as we can see up here. And then I did mention a bond ETF, or actually it is a closed-end fund, and that's important to note for tax purposes and otherwise. This is HDT, the John Hancock Tax Advantaged Dividend Income Fund. Had a nice boost today with those yields coming down lower. So looking rather interesting there. Last up, we're going to take a look at some insurance stocks that are continuing to outperform the broader markets. This is Chubb CB. You can see that this longer term base, we're just on the cusp of breaking out with a positive RSI and MACD. Travelers is another name that's sitting up here quite nicely. And again, if we pull up that weekly, you'll get a better sense of that long-term potential base breakout here, sitting really a point or two away from about an 8-month base breakout. And that would be very constructive because generally speaking, certainly in bullish periods, the longer your base from the stock is breaking out of, the longer the eventual potential advance out of that base. Allstate, another stock in that insurance that is area that did experience a base breakout earlier this month and then has been back and fill since then. Not a big yielder, 1.8%. It's more notable as it relates to the fact that this is an area that is still sitting up here quite nicely. Marsh Mac, this is a name that is an insurance broker, did experience a base breakout this week. We did also subsequently see that MACD crossover. We have a positive RSI, not a big yielder, 1.3, but net it is improving and hitting a near-term high in the face of moves higher in insurance stocks. And that is it for next week. Of note again is the fact that we are going to have those tariff announcements on the 2nd of April. What you will want to be on the lookout for relative to those tariffs is really how long they are going to be in place, how steep the tariffs are going to be, and then which countries are going to potentially retaliate from those tariffs. So a lot of very founded fears in the markets at this point in time. You can see that the broader indices are setting up for more potential downside at this particular time. And of course, as always, subscribers to my MEM Edge report are going to be well tuned in on Sunday relative to other activity taking place in the broader markets, and also will be very quickly alerted when the markets turn bullish. That's it for this week. I'll see you here next Friday.